So this is Richard Farley, the person on your screen right now. He is somebody who used to star on Dragon's Den. Now, I don't need to tell anybody who watches my stream regularly that I am not particularly enamored with the kind of people who would be employed by Dragon's Den. So let's just say I'm already polarised against this man. He is worth £160 million. That's his estimated net worth, chat. This is a video he has done for City AM about why a wealth tax won't work. I wonder if there's any motivated reasoning why a person with £160 million worth of net worth might think that a wealth tax is bad. I couldn't possibly comment, could you, chat? Anyway, as somebody who knows a lot about taxation and wealth taxes and is a fan of wealth taxes, what I'm going to do is I'm going to debunk this video for you and show you why Richard Farley, the multimillionaire, is wrong about wealth taxes. Let's go.
I'm here to tell you why a wealth tax won't work. Yes, something is wrong. The system has clearly failed a lot of people. Approximately 43% of the UK's wealth is owned by the richest 10% of households. Now, I grew up in the care system and I spent time in an orphanage, and I'm one of 11 children. My brothers and sisters are all working class, so yes, I understand the sentiment behind the calls for a wealth tax, and I understand the passion with which activists like Gary Stevenson speak when they advocate higher taxes on the rich in the name of social justice. It's easy to want to tax people more, especially when they're wealthy. But I've also studied economics and mathematics. I worked for 5 years at the Central Bank in Australia. And while my heart sympathises, my head and my experience tells me that a wealth tax simply won't work. There's been talk of charging, say, 2% on fortunes above, say, 10 million. It sounds bold, urgent, and at first glance it sounds fair. But it's a kind of policy that reflects how polarised our world has become.
What do you think is patient zero for the polarisation, Richard? Do you think it's just people being mad at you because of envy or jealousy? Or do you not think that there is a fundamental imbalance in the structure of the economy that allows some people to be richer than God whilst the majority of people can't get on? Again, like, we got away with high taxation before this huge amount of wealth was accumulated in so few hands, and that was the whole reason for it. We had a high tax rate to make an entrepreneurial economy not turn into a rentier economy. And now we have a rentier economy. And you know full well, Richard, that we have a rentier economy, because that's what you do. You're a private equity boss. You make money off of your money by buying other people's work for them and extracting equity. You don't actually produce or provide anything. You're not an entrepreneur. That's parasitic. That's not productive. And that was the whole point of high marginal tax rates, so that incentivise entrepreneurship and reinvestment rather than skimming off the top.
It's the sort of thing Donald Trump would do if he were a left-wing politician.
Excuse me? Excuse me? Is this a false equivalence I'm seeing here? And given that Donald Trump is essentially a fascist who's undermining the Constitution, this is basically like him saying trying to tax wealth is communism. That's what I'm inferring here.
It's emotionally satisfying, but it's economically flawed. The first problem is practical and concerns implementation. It's not easy to define, identify, value, and enforce a tax on wealth. How much is a piece of art worth? An unlisted business? A farm? These things don't sit on the stock exchange with an easy price tag. Valuing them accurately is difficult, intrusive, and expensive.
And yet the Norwegians manage just fine. And even then, if you really wanted to leverage a wealth tax in this country, the vast majority of that is going to go into land and property, which is very easy to value. Even if you just did a land value and a property value tax, which would be a form of wealth tax, not the same as what the Greens or Gary Stevenson are proposing currently, but it is a wealth tax, an asset tax. That'd be very easy to administer, very easy to adjudicate, and also would be very difficult to avoid, because you can't just pick property and land up and take it with you. Even outside of that, the Norwegians have a wealth tax and it is successful. So we could just use their model for a wealth tax.
It would take an army of tax inspectors and accountants to even attempt it. Then comes the issue of liquidity. If someone owns a farm or a house worth 10 million but has little cash flow, how do they pay the tax? Sell their home? Their business? It's not a thing.
Yes, you sell the assets. The whole problem with accumulation of wealth is that the rich have subsumed all the assets, so working and middle class people cannot generate wealth because the assets have had extra liquidity pumped into them by the rich so that they can control them. A wealth tax wouldn't just raise money for the state, it also frees up assets by forcing the rich to sell them. If you live in a £10 million house, I don't care that you have to sell that and maybe downsize to pay your taxes and contribute to society. And even then, it would have to be more than £10 million, at least, for you to be forced to sell it to pay for tax purposes, because the 2% is only on money over £10 million. It's a marginal tax. And as has been pointed out in chat, we have a housing shortage and a housing crisis. You shouldn't be living in a massive house by yourself. And if that sounds unfair, tough. Life isn't fair. And on top of that, as has also been pointed out in chat, the way in which rich people can pay for things is because they leverage their assets to take out loans. Again, exactly how Elon Musk bought Twitter. If you've got £10 million of assets or more, which is what the wealth tax we're discussing would impact, you have plenty of collateral to take out new liquidity through loans.
Theoretical problem. It's a very real problem. I was once investigated by the tax department. My taxes were in order, but it still cost me a fortune in fees. That kind of disruption multiplied across thousands is not just inefficient, it's destructive. Next is the question.
Well, no, that means that you're paying for the services of legal advisors. That's money and a transaction that would get taxed at point of sale under the income of the people, again, who are actually doing work. Whilst I don't have a particularly high opinion of lawyers, at least lawyers do work. At least they have a real job. Matey boy over here, he doesn't have a real job. He turns money into money. He's not productive. That's not a service. At least lawyers provide a service.
Of behaviour. Common mistake is to calculate the revenue from a wealth tax without considering how people will react. The wealthy are, by definition, mobile. I've seen estimates that there are around 25,000 people in the UK with over £10 million. With the recent changes to non-dom tax relief, around 10,000 have already left.
Again, the statistics on people leaving the UK for tax reasons comes from the Henley and Partners High Net Worth Individual Migration Report, and their source for people leaving the country is people changing their locations on LinkedIn. This is hardly watertight data now, is it? And second of all, if the rich are mobile, first of all, they can't take physical assets with them, such as land or property. And second of all, you can just impose an exit tax. Switzerland has an exit tax and they have a wealth tax. If you try and move your assets out of Switzerland, they will charge you an exit tax. And we can do the very same thing. And even then, he says that the tax policy might not calculate the total flight response to it being imposed. And yet the Green proposal at the election, take that into account. Most people who devise tax policies are acknowledging the externalities that might create.
It's easy to imagine thousands more doing the same if a wealth tax is introduced. Plenty of countries are opening up routes for the mega-rich leaving the UK. And when they go, so does the tax revenue. And they may not come back. I know people wealthier than me who are leaving. Just the VAT they pay each year probably funds a handful of teachers, and they don't use the NHS or government schools. Meanwhile, countries like Portugal and Italy are offering tax breaks to attract the very people we're pushing away. You don't have to like them, but you do have to consider their impact on the economy.
The thing is, lots of the people who have high level of asset wealth aren't actually that particularly financially important. The thing that is good for an economy is productive business. Whether that is state-owned or privately owned, productive business is where the wealth comes from. It's the creation and generation of goods and services. This guy, private equity. He's not producing anything. He's not doing anything. He's buying stakes in other people's productive enterprises and skimming off the top.
Once introduced, a wealth tax won't go away. Inflation will erode thresholds, and successive governments will be tempted to widen its scope.
Yes, because as both assets and commodity prices inflate, so do thresholds. That means it's the same in real terms. That's not an argument.
Seen the same happen with inheritance tax. And history gives us plenty of warning. Wealth taxes were once common, but most countries abandoned them because they were too hard to implement and they raised little revenue. Spain's wealth tax brings in less than £500 million a year. France tried one and saw capital flow.
No, they got rid of it because Conservatives came into government who wanted to benefit their rich mates. And even then, the Spanish wealth tax is raising £500 million more than it otherwise would be doing if they didn't have it. And on top of that, it's getting the rich to sell their assets. Spain is the fastest growing economy in Europe, by the way.
Flow leaving. We should aim to be more like Singapore rather than like Spain. Now, about the bigger picture. I agree the system feels broken, but a wealth tax won't fix the root causes. Productivity per person hasn't grown despite amazing technological advances. Fewer people want to work. Social media has replaced religion as a dominant narrative.
Literally, this person comes here saying, look at all this evidence showing you that taxing me specifically is a really bad idea. His justification for the real problems in society is not parasites like this guy skimming off the top and taking out the assets of society for himself. No. I'm not the problem. It's that social media has replaced religion, is his theory as to why there's a problem in this country. Yeah, productivity is low. This is because of a lack of state investment. This is because of austerity. We tried cutting taxes. It didn't increase internal investment. It didn't even increase FDI. Investment has been really low in this country, regardless of where we've put our tax rates. This isn't a taxation problem. This is an austerity problem. Because we don't have productive workers, because our healthcare system got ruined, our public realm got shredded, and we are poor with substandard, low quality, low supply housing because of things like right to buy, financialization, and landlordism, and our children have stunted growth. I can't believe all these benefit cuts led to a lack of productivity. We also have a lack of investment in things like R&D, in having state-led innovation. We're not an innovative economy. You know what the most innovative department anywhere in the world has been over the last 100 years? It's DARPA. DARPA is the government body in America that does all of their innovative research. And that's led to a bunch of the technological advancements that has carried total factor productivity to the present day. And that was state invested. We've not done any of that. That's why we have low productivity. Yeah, his answer for this? Social media. Literally reading tea leaves, chat.
But while religion preached discipline and effort, social media often glorifies easy living. And whereas a dream for young people, home ownership used to be the goal. Now it feels out of reach.
Literally, you are the problem. People like you bought up all of the houses, turned them into financial assets and speculated on them, both in the run-up to 2008 and now. Sure, we've not built enough. Our planning system is bad, right? But if we hadn't incentivized people to use houses as a store of value rather than as a commodity with a use value, we wouldn't be in this mess in the first place. You are to blame for this. People like you.
A wealth tax won't increase the housing stock.
No, but it will for people to sell their houses if they have multiples so that they can pay their wealth tax bill. It frees up assets, therefore increasing the supply that's on the market for people to purchase, therefore reducing the price. It would move the supply-demand curve down.
In fact, it may do the exact opposite. That's a planning and supply issue, not a taxation one.
And it's both of those issues.
To reduce inequality, let's start by being smarter with the money that we already spend.
Not increasing public spending is literally the reason why we have poor inequality. This guy's answer to dealing with inequality is more austerity. Again, just neoliberals living in a nonsense neoliberal monetarist world that was dead 15 years ago, and they have been dragging its corpse along like Weekend at Bernie's ever since 2008. Desperate not to realise that these people are the problem.
Politicians argue about black holes and unfunded commitments, but the picture remains largely the same whoever's in charge, ever-increasing spending with uncertain outcomes. We need transparency, efficiency, and long-term planning. So yes, the frustration is real, the inequality is real, but a wealth tax is not the solution. Let's use our heads, not our hearts. What I'd like to see is we've all heard about this £20 billion hole in the finances, which we found out about just after the election result. I'd like an inquiry to know where that money went.
It's literally in the OBR's report, Richard. You have a net worth of £160 million. I'm an idiot with a YouTube account. I read the OBR report. I know that it went on departmental overspends at the Home Office and a couple of other departments with overspends, mostly at the Home Office though, and then £11 billion spent on dealing with the public sector pay awards that were advised by the pay review bodies. I know all of those things, and I'm an idiot with a YouTube account. My net worth is nothing. It's the assets I have in my room right now. You have £160 million of net worth, and you can't scrape together the mental wherewithal to be able to look into the OBR's report. Meritocracy that way, chat.
Someone's lying. I want to know where that 20 billion went and what it was spent on and whether there really is a hole. If the UK was a company, we would be getting real-time information on our expenditure. We wouldn't be getting a surprise 2 or 3 years later about the state of
Does this motherfucker not remember Enron? Like, businesses get away with shit like this all the time.
the finances. The other thing I want to see is non-DOMs. There's talk of non-DOMs leaving. I want to see the information. The tax department has the information, therefore the government has the information. How many non-DOMs are leaving? We've just had the end of the tax year. And what is a true estimate of what those people used to add to the economy? I don't want to kick people out because I don't like them. I want to do what's best for the economy. So if it's good to have non-DOMs, and that's why other countries are trying to pinch our non-DOMs, change the policy and keep them here. If they're not adding anything, fine, let them go. But let's do it with information and make that information public. And as I say,
I mean, at the end of the day, what would really solve all of this issue, and I hate to be glib about this chat, is putting these people in the Tesco gulag. Like, honestly, the way these people talk about the public realm, it's like, how dare you ask people to contribute, to the country that makes people rich. Again, these people don't get rich without a public realm there to facilitate it. And think, how dare these people pay in? It's like, we need to be smart about this because these people are mobile. I'm like, you're not so mobile when you're in the camp, are you? Not particularly mobile when we're forcing you to work in retail, having confiscated all of your assets, huh? These people have not been scared for too long. It's time they were scared again. Make the rich scared again. Let's go.
The 20 billion hole, I want to know more about it. The wealth tax is not the answer. A change in policy and more careful spending, that's the answer.
Literally, he has no answer to inequality at all. Just be more careful with spending. Again, the idea of efficient spending has been the modus operandi for government in this country from 2010 until today. And all it's done has led to the destruction of this country and an increase in inequality. I mean, Warren Buffett supports taxation on the wealthy because he considers it as guillotine insurance. That's what Warren Buffett describes it as. Because he realises that without wealth redistribution, without a social contract, without a public realm and a welfare state that creates a basic standard of living for everybody, without broad common prosperity, the rich will end up losing their heads. And I don't want that. And they don't want that. So maybe pay some taxes. Hey there, if you enjoyed the video, make sure that you like and leave a comment. That helps the video out in the algorithm. If you subscribe and ring the bell, it'll let you know when I go live. I stream every day on YouTube and Twitch. You can also follow all of my socials down in the description. And if you want to support me in a more financial manner, there's a join button for membership to just 99p to be a member on YouTube, as well as a Patreon, and there's some merch there as well. And hopefully I'll catch you on the next video. Take care.